Did you know that during the 2008 financial crisis, the Dow Jones Industrial Average plummeted by 54% in just 18 months? Just let that sink in for a moment. That's more than half of its value, gone, in a year and a half. This is the shocking reality of market crashes. They're not just a blip on the radar, a minor dip in the graph. They're seismic events that shake the very foundations of economies and can leave even the most seasoned investors reeling. Picture this. It's 2007, the economy is booming, the stock market is on a roll. Then, out of nowhere, the housing bubble bursts, and the financial world descends into chaos. Banks are collapsing, companies are going bankrupt, and people are losing their jobs. The Dow Jones, a barometer of market health, reflects this turmoil as it takes a nosedive. This was the 2008 financial crisis, one of the most devastating market crashes in recent history. It was a time of uncertainty and fear, but it was also a time of change. For those who had been riding the wave of the bull market, it was a wake-up call. It was a stark reminder that what goes up must come down. Market crashes are a part of the economic cycle. They are the reset button, the great leveler. They wipe the slate clean, making way for new growth. But they also expose the vulnerabilities in the system, the cracks in the facade. They force us to reassess, to rethink, to reevaluate our strategies and our priorities. For investors, a market crash can be a nightmare, but it can also be an opportunity. It's a chance to buy low, to pick up bargains, to take advantage of the panic and the pessimism. It's a time when fortunes can be lost, but also when fortunes can be made. But as shocking as these numbers are, they also present a unique opportunity for savvy investors. So let's dive in and explore how you can navigate these tumultuous times and come out on top. Because when the market crashes, it's not just about surviving, it's about thriving. Scene script. Let's turn back the clock and delve into some historical market crashes. Picture October 19th, 1987, a day now infamously known as Black Monday. A day of panic selling where the Dow Jones Industrial Average plummeted 22% in a single day. But while some investors were running for the hills, others saw a golden opportunity. They scooped up undervalued stocks, and when the market eventually recovered, they reaped the rewards. Fast forward to the turn of the new millennium, the dot-com bubble burst, and the tech-heavy Nasdaq Composite lost a staggering 78% of its value. But amid the rubble of failed internet startups, a few gems stood out. Companies like Amazon and eBay, which were then just fledglings, were able to weather the storm. Investors who recognized their potential and had the courage to invest during this downturn are now sitting on a fortune. Then there was the 2008 financial crisis, a downturn so severe it earned the title of the Great Recession. The housing market collapsed, banks went under, and the S&P 500 lost over 50% of its value. But even in this bleak scenario, opportunities arose. Investors who bought into the market at its lowest point in March 2009 saw their investments multiply several times over in the following decade. So, who were these savvy investors? They were people like Warren Buffett, who famously said, "Be fearful when others are greedy and be greedy when others are fearful." They were those who understood that a downturn is a clearance sale of the stock market, where great companies are available at discounted prices. But let's be clear, investing during a market crash is not for the faint-hearted. It requires a strong understanding of market fundamentals, nerves of steel, and a healthy dose of patience. It's not about timing the market, but about time in the market. As we can see, market crashes, while devastating, can open doors to profitable investment opportunities. So, how do seasoned investors navigate these tumultuous market downturns? Well, let's dive into it, shall we? First off, our financial gurus emphasize the importance of diversification. Consider the stock market to be like a lavish buffet. You wouldn't just pile up your plate with mashed potatoes, would you? Of course not. You'd want a bit of everything. Some protein, some carbs, and yes, even those glittering desserts. Similarly, a well-diversified portfolio contains a mix of different asset classes like stocks, bonds, real estate, and commodities. This way, when one sector is performing poorly, others might be thriving, balancing out your losses. Next up is the concept of long-term investing. It's like planting a seed and waiting for it to grow into a tree. You can't expect a sapling to sprout overnight, right? Similarly, investments need time to mature and yield returns. Market crashes, while scary, are often temporary. Historically, markets have always bounced back over time, so hold your nerve and don't let a short-term downturn scare you into selling your investments at a loss. And finally, there's the age-old adage, buy low, sell high. Easier said than done, right? But here's the catch. A market crash often presents the perfect opportunity to buy stocks at discounted prices. It's like a Black Friday sale on Wall Street. But remember, not all markdowns are bargains. So, do your homework, analyze the company's fundamentals, and only then dive in. But here's a word of caution. Investing during a market crash is not for the faint-hearted. It requires a cool head, a keen eye for opportunities, and a healthy dose of patience. So, if you're the type to lose sleep over daily market fluctuations, this might not be the strategy for you. Remember, the key to investing during a market crash is patience, diversification, and a long-term perspective. So buckle up, brace yourself for the ride, and who knows, you might just come out the other side with your pockets full. Now let's hear some success stories of those who thrived during market crashes. Our first tale takes us back to the Great Depression. While many were losing their shirts, a savvy investor by the name of Jesse Livermore was busy making his fortune. Livermore spotted the signs of an incoming crash and shorted the market. His strategy? Simply put, he sold stocks he didn't yet own, predicting he could buy them back later at a lower price. His foresight led him to accumulate over $100 million, a colossal sum for the 1930s. Let's fast forward to the dot-com bubble of the late 1990s. Many investors lost their hard-earned money as tech stocks plummeted. But there was one who didn't. His name, Warren Buffett. Buffett's strategy was grounded in value investing, buying stocks that were undervalued by the market. He was criticized for not investing in tech stocks during the bubble. But his caution paid off when the bubble burst and he emerged unscathed. Next, we visit the financial crisis of 2008. While banks were collapsing left and right, John Paulson, a hedge fund manager, saw the crash coming. He placed bets against subprime mortgages through credit default swaps. This move earned him and his investors a cool $15 billion. These stories serve as a powerful reminder that identifying opportunities and mitigating risks during market crashes can lead to significant gains. Each investor had a different strategy, but they all had one thing in common: they didn't follow the herd. They made informed decisions based on their analysis and understanding of the market. In a market crash, it's easy to let fear dictate decisions, but as these investors have shown, it's those who can maintain a cool head and stick to their strategies who often come out on top. These stories show us that with the right strategy and mindset, it's possible to turn a market crash into a valuable opportunity. As we've seen today, market crashes can be both a threat and an opportunity. It's like a coin with two faces. One side is the potential danger of significant financial loss. The other is the opportunity to buy valuable assets at bargain prices. We've journeyed through historical market crashes and found that even in the midst of financial chaos, there were those who thrived. Their secret? A well-thought-out investment strategy and a long-term perspective. They saw beyond the immediate downturn and focused on the eventual recovery. We've also heard from the experts who emphasized the importance of not letting fear dictate our investment decisions. Remember, it's not about timing the market, but time in the market that matters. Finally, we've celebrated the success stories of those who seized the opportunities presented by market crashes. Their stories are a testament to the potential rewards of patient, strategic investing. So the next time you hear about a market crash, don't panic. Instead, see it as a potential opportunity for investment.